Hello, everyone. Welcome back. Today, we're talking about a technique that I've been working on, which presents and proposes a framework for determining deep value opportunities in the market. So let's get started with that. There is one specific tool that I've been using, and I just actually introduced it a couple of weeks back in one of these videos. And we're going to talk a little bit more about that. So what is value? When we talk about value, deep value, what is value? Right? Value is when an asset trades at a discount to what it should be worth. So, and what happens in the equity markets routinely is that earnings today, meaning this, today, this year, this quarter, they're always valued more than earnings from a year from now. And that's because of the opportunity cost of capital, right? And as we discount future earnings back, then mathematically earnings, a year from now are worth less than earnings today. However, what tends to happen is that even though that's true, sometimes stocks are excessively weighted on today's earnings rather than long run earnings. So, we see this happen quite often where stocks overshoot both to the upside and to the downside. When bull markets get going, people get extremely optimistic, which is fine. But then, it reaches levels that, is, kind of overdoing it. At the same token, that happens to the downside. When stocks enter a bear market, the short sellers, get overexcited and stocks often overshoot to the downside. Oftentimes that's because of forced selling due to margin calls and, panic setting in. So that sends stocks artificially too low. So what happens is stocks get, out of whack from intrinsic value, often enough. And what ends up happening then is that they get overweighted on what today's earnings are rather than their long-run stream of earnings. And I believe that this disconnect is best captured by the CAPE ratio. CAPE stands for the cyclically adjusted price to earnings ratio. It's also known as the Schiller PE. So what's the problem with traditional PE, right? The problem with traditional PE, either trailing PE or forward PE, they both have this problem, is that it's always relative to one point in time. So if you look at this is a chart of the S&P 500, and here are the S&P 500's earnings over time. And you can see that it goes through cycles, through the business cycle. The problem with PE is that it looks at earnings at one point in time. So what happens is during bull markets, stocks actually look cheap because earnings are extremely, inflated well above long-term trend. If you were to draw a regression line on this, a line of best fit, you would see that half the observations would fall above and half the observations would fall below. So what happens in bull markets is that earnings, rise well above trend. And when that happens, that usually leads to malinvestments, it leads to excessive spending, and recession ultimately sets in, which seeks to correct all of that excess, investments and spending. And that's what leads to recessions. And then, of course, if there's one or two major catalysts, like a big bank going under, that, tends to amplify the magnitude of the recession. But even if it doesn't happen, there are natural cycles. And so what happens is earnings get artificially inflated during, bull markets, and then they get artificially deflated during bear markets. So PE, the problem with PE is that you're using just one point in time. So that would be heavily dependent on your frame of reference. If you're looking at PEs during the Great Recession, let's say during early 2009, then PEs actually would look very inflated. So you would think that, stocks are a sell because the earnings are so low. Even if, stocks are down significantly, PEs are very, very expensive. And so you'd wait for that PE to come back down in order to buy the market. And by that time, you would have missed the opportunity which presented itself near the lows here. In the same token, during bull markets, even though we had a little bit of PE multiple expansion here, earnings are very, very strong. And so you would think that, stocks are cheap because earnings are exceptional. But remember, that's, above trend. And inevitably, earnings mean revert, right? We know this because of the business cycle. That's a principle that we've been fixated in for, 100 years. Earnings, as well as economic growth measured by GDP and GDI, they inevitably go through cycles, and earnings are no different. And so, when you're looking at PEs during a bull market, you would say, well, the PE might be 17 or 18, but you see very strong earnings growth, and so we can justify that. Well, the problem with that is that, you're using the frame of reference, which is at the cycle peak. So PEs are extremely vulnerable at the turn of the cycle. If you're getting it early on, that's fine. But if you're near or anywhere close to the turn of the cycle within plus or minus 1 year, then then the PE is sending you an incorrect message. So again, traditional PE, including forward PE, they make stocks look cheap during bull market peaks, while looking expensive during bear markets. So we need to start thinking exactly opposite of that. So how do we do that? How can we measure that quantitatively? We would do this by, rather than focusing on price multiples on a single year's earnings, okay, that's what PEs do. We just take a look at just this year or just next year and look at the multiple to that. Rather than doing that, we ought to focus on a smoothed long-run trend earnings average. This is often called normalized earnings, okay? So here we see an example of that. So, now I'm just showing you a chart of the S&P's earnings over time. And overlaid on that, you can see that this is the regression line. So this is the long-term trend earnings growth. So if we could look at the multiple relative to that trend earnings growth, rather than being too caught up with bull market peaks and bear market troughs, we want to know what's the midpoint of the cycle. That's where earnings will inevitably gravitate back towards. So even if we're well above trend, chances are we will revert back to trend. And when we're below trend, chances are we will revert back to trend. That's a long-term principle of economics and markets. Every single time we have a bull market, there becomes excessive spending, excessive consumption, which then corrects itself, and that's what we call a recession. So we should not be interested in neither the bull market peaks or the bear market depressed earnings. We want to know what is the long run average. So the Schiller PE looks at the multiple to that long-term earnings trend growth. Because if we can do that, then we would know exactly when stocks are truly cheap and when they are truly expensive. So again, rather than finding low PE stocks, which depends on a single year's earnings, we want to find stocks that trade at low multiples to normalized earnings. And that is, the earnings represented by this, long-term trend earnings growth right here. When we do this successfully, we can exploit situations where short-term difficulties are being excessively weighted over the company's long-run trend earnings growth. So we see this happen all the time when companies fall into difficulties. We see this throughout the market even today. When companies are facing, company-specific issues, or even when the market overall is facing a recession, remember, the market always weights the most immediate earnings the most. So during bull markets, the market weights that bull market above trend growth more. And then during bear markets, the market weights the depressed earnings a lot more. And that's what causes these deep bear markets followed by spectacular bull markets. So what we want to do is we want to understand when stocks are truly cheap. And the only way to do that is by looking at the multiple relative to normalized earnings growth. So again, what if we looked at the multiple, for example, this is a company, Celanese. I really like this company a lot, but Celanese goes through cycles. You can see because Celanese is a manufacturer of durable polymers. These are, industrial, materials that go into a variety of industries like automotive, other, types of companies like adhesives, other industrial companies that use their products. So they are, ultimately sensitive to business cycles. However, look at the chart. Over the long run, they do compound earnings. So looking at normalized earnings is optimal for a company like Celanese. And if you can get the timing right, then you can earn significant alpha by getting it correctly on companies like Celanese. So I'll present to you a framework of how to use Schiller PE, what the best sort of collection of companies are. But Celanese is a perfect example because it goes through these cycles. And when it does, the stock reacts quite sharply, to those earnings whenever they come down. And then the stock reacts quite sharply to the upside as well. But as you can see, the company does successfully compound earnings over time, even though it goes through these cycles. However, Shiller PE, which looks at normalized earnings, does a fantastic job of getting it correct when the right time to buy, this company is. And remember, it's a pretty volatile company because of this volatility in earnings. But remember, over time, the company does compound earnings. This is a company that, checks off a number of other boxes, which I'll go through in just a minute here. But, if we can get the timing right by looking at normalized earnings, then you can earn, I believe, significant alpha on companies like Celanese. So enter Shiller PE. What is the Shiller PE? So the Shiller PE looks at the multiple that stocks trade to relative to 10-year average real earnings. Okay, so there's a number of components to that. 10-year average real earnings. So this achieves two things simultaneously, right? So we achieve that smoothing out, right? That normalization of earnings. So we're not too concerned about short-term events. We're not concerned about, excessive bull markets, right? When, stocks get well above trend. And we're also not concerned about bear cycles either, right? We want to be extremely, our temperament needs to be extremely resolute and look at the midpoint of the cycle rather than either the above trend or below trend events. So the Shiller PE smooths out those short-term events that are affecting earnings, either bullish or bearish, by looking at the 10-year moving average. So we look at, for every quarter, it recalculates the 10-year moving average of annual earnings, okay, and looks at the multiple to that. And then number two, it focuses on real value creation because it adjusts earnings for inflation. So if companies can't grow earnings per share in excess of the CPI growth, then they're not creating value. So Shiller PE does a phenomenal job of smoothing out those short-term events by using 10-year average earnings. And we don't, get caught up in companies that are not creating value, because they're not actually compounding earnings faster than CPI. Okay, because if companies are not matching the rate of change of CPI, then they are, actually not creating value on a real basis. So this is a very strict set of criteria. They need to be creating real value by compounding earnings faster than the CPI. And we're looking at the multiple to the 10-year moving average of those real earnings. Okay, so what's the track record? You can see that right here. This is taken from Robert Shiller. His website is listed down here at the bottom. This is a phenomenal data set. What he has done here is looked at the CAPE yield. So it's the CAPE ratio inverted. So that way we can kind of create a positive correlation with subsequent, so that's forward 10-year annualized real returns. Okay, so the blue line is the CAPE yield. So that's the CAPE ratio inverted. And as you can see, as stocks rise in the CAPE yield, the forward 10-year returns also rise. And that makes sense because stocks are cheap, right? Remember, this is the inverted PE ratio. So it's kind of like the earnings yield. So as the earnings yield rises for stocks, and this is for the S&P 500, the 10-year forward return also rises. And then subsequently, as the earnings yield falls, the forward 10-year return also fall. So this is quite an interesting, correlation, as you can see here. It hasn't been perfect. There are, sometimes head fakes, like for example, in the late 1800s, the CAPE yield was low to negative, and yet forward returns were quite strong. But besides that period, and also besides the most recent period, where the CAPE yield got, it did increase, by the way. It did get attractive at above 5 to 7% here, and the forward return of the market was quite strong, as we all know, from 2013 onward. So the latest observation is 2013, because that gives us the forward 10-year returns through today. Obviously, we can't update the chart just yet until we move forward into the future. But you can see now that today the CAPE yield has moved quite lower, and I believe it's actually going to move even lower since we've had a pretty strong bull run in the market. This means that inevitably the forward expected returns on the market is going to come down. I believe it will catch down to where this number is. So therefore, the next 10 years may basically look like roughly, somewhere in between 0 and 5% on a real basis. So remember, this is a real return, so this is in excess of CPI, which is not bad, but not great. Nothing like what we saw over the past decade. So again, the point of this chart was to show that it's had a pretty good correlation, a pretty good track record at predicting forward 10-year returns for the market. So let's look at the pros and cons just to make sure that we don't, misuse this indicator. So the Schiller PE works really well with companies that go through cycles or are currently in a special situation where companies experience short-term difficulties. And it assumes that the company will eventually work through its period of difficulty and get back to rising earnings. So remember, going back to the Celanese example, this is a perfect example because it goes through cycles, but inevitably the company works its way through that cycle and grows earnings over time. So the Schiller PE works well with companies only that go through cycles, number one, and number two, have a very, very strong track record at being able to bounce back from these types of cycles. Okay, so it only works, you only earn positive returns when you buy low Schiller PE stocks, and the company eventually gets back to earnings growth and gets back to trend growth, that is. So it does always get back to this trend long-run earnings growth. So that's number one. However, what it doesn't work well with is when companies go through rapid disruptive earnings growth, like Apple, Nvidia, Amazon, because the 10-year moving average of real earnings is mathematically slow to move, right? So when we have these iconic examples of Apple throughout the late 2010, like the late 2000s, and the early 2010s, went through a parabolic move. Same thing with Nvidia right now, Amazon as well, for the past 20 years. And Amazon didn't even show positive earnings for half that time. So, these types of examples, the Schiller PE won't work too well with. Because remember, if you're rapidly growing earnings, then remember, what is the Schiller PE doing? It's always calculating the multiple to the 10-year moving average of real earnings. And because it's a 10-year moving average, it's always going to be slow relative to the most recent quarterly observations and forward guidance as well. So the Schiller PE should not be applied to rapid growth companies. Rather, the Schiller PE works well with, again, companies that go through cycles. Oil stocks are great examples of this. But preferably, my preference is companies that do compound earnings over time. So Celanese is a great example. Caterpillar is another terrific example. Just, any companies that have a chart that looks like this, where it goes up and down and up and down and up and down, but grows over time. If you can find stocks like this, then the Schiller PE will be it'll be an exceptional way to time the entry into those types of companies. We'll take a quick look at that. Clorox is actually a great example. Clorox got extremely cheap, but how could you have seen it, right? Because look what happened to Clorox. For decades, Clorox quietly compounded earnings, right? It doesn't go through cycles at all, right? So this is not like Celanese. Clorox doesn't have cycles. Why? Because bleach is always in demand. Whether we're in a bull market or bear market, these cleaning products are always in demand. However, what happened during the COVID period is that earnings went parabolic, right? Because everybody needed bleach. Everybody wanted to disinfect everything that we touched from the outside. So, inevitably, Clorox got a huge surge in orders and demands. If you remember, for a time, it was hard to find, bleach and other cleaning products in stores. It was all gone. So earnings, went through the roof. The stock price reacted quite swiftly. And then what happened? Earnings went way down, and so did the stock. Why did this happen? It happened because due to the exceptional demand, right? Clorox took that as kind of a false signal, because at the time, nobody really knew how long COVID would last, how long, this, demand for, bleach would last for. So Clorox ended up investing rapidly into expanding production in order to meet this record growth in demand. And then what happened, right? COVID ended. The lockdowns ended. We kind of all, went back to reality, back to normal. And so because they had all of this excess capacity, it all, suddenly went idle. They were only running at 50 to 60% capacity at that point. And so demand went way down. But you have all of these new factories and new, employees, right? The headcount increased. And so therefore profitability went way down after that. Because when you're running at well below capacity, that's a lot of fixed costs and not a lot of revenue anymore. And so that's what, sends earnings per share at the bottom line way down. And the stock went with it, right? So if you're looking at PEs, right? If you're looking at the PE of Clorox, it went way up, even though the stock went into a deep bear market. Because of this depressed earnings, the PE shot up, way up. So if you're looking at PE, and if you're an investment manager, I would be like, well, why would I pay a 40 PE for Clorox, which just makes bleach and grows at 3% or 4% long term? I would not touch that stock at all. Well, if you look at Schiller PE, that's what gets you the signal, right? And here is an example of Schiller PE working its magic. Schiller PE got down to recessionary levels. So at this point, at one point in 2022, the stock got so cheap that it matched the Schiller PE at the lows of the great financial crisis of 2008, 2009. That is very cheap. That is priced for recession. And it really doesn't get much worse than what happened in 2008, 2009. So if you can find stocks that trade, at a Schiller PE that's close to where they were in 2008, 2009, chances are that's a pretty high return, low risk type of a bet. And that's exactly where Clorox got. And look at the return on Clorox year to date. It's been phenomenal. A lot of that is because of multiple expansion, because it's getting back to a normalized multiple after it got excessively cheap. So remember, we're interested in long-term normalized earnings growth here. We're not interested in these temporary cycles that companies go through. That was a temporary difficulty, right? But as long as you are picking a company that has a long track record of steering the company through all sorts of environments, then the bet is that the company will inevitably get back to long-term trend earnings growth. That is a time-tested sort of principle that Schiller PE does best with. And remember, stocks overweight the most immediate earnings. So when stocks go through earnings recessions, the stock price will react quite sharply to that, even though long-term trend is not going to be changed much at all. So Clorox got cheap. So Schiller PE, once again, it helps you identify stocks that are excessively being punished for short-term difficulties. And that leads to high implied forward returns over the next 5 years. So that's exactly what we want to look for. So here's my general framework. This is where Schiller PE does best, in my view. We want to look for Schiller PE stocks that have recently reached 1 to 2 standard deviations below the 20-year mean, or has reached recessionary levels around where they were in 2008, 2009. Okay, so remember, we looked at that for Clorox, 1 to 2 standard deviations below 20-year average. You can see that right here. And in fact, this is actually a 30-year average. But the 30-year average was about 27. It got, 1 standard deviation below that. But more importantly, it got basically matched where it was during the 2008, very closely. It did briefly get below that, but, it doesn't have to be exact. As long as we're in the ballpark, it is a high reward, low risk type of a bet to make. So here are the criteria. So we want the Schiller PE to be somewhere between that 1 to 2 standard deviations below 20-year average, or has reached levels last seen in 2008, 2009. But here's the kicker. The company must be an industry leader, okay? So you could try this for, untested companies, meaning, stocks that have only been around for 10 years or so. But that increases the risk, okay? So you have to have a pretty high confidence that the company will successfully navigate through this short-term difficulty and get back to growth, right? If you can answer that confidently, then yes, it's still a go. But I like to look for companies that are industry leaders with a long operating history, at least 20 years, and a strong moat. Moats can be in the form of brand awareness, like Clorox, R&D, expertise, and network effects, exactly like Celanese, economies of scale and being a cost leader, again, that's Celanese, products and services that are needed over wanted. That's a big plus. Okay, so if these are companies, if you are finding a company that has that box checked, then it would be a strong candidate for Schiller PE. You also want strong compound earnings growth over at least a 10-year period, if not 20-year period. So again, earnings should be going up, right? You don't want to be picking stocks that are going down in earnings, because then you're just kind of betting on a recovery back to long-term mean before the stock just continues its downward trend. I also don't like to own oil companies, because even though they are an industry leader like Exxon and Chevron, if you look at their earnings, they don't actually grow over time. They're just kind of sideways, cyclical. So in my sort of experience in looking at the data, the best returns come from companies that have, all 4 of these boxes checked. So we want strong compound earnings growth over a 10-year period. How much should that growth be? That really depends. It doesn't have to be, say, 20% earnings growth or 30% earnings growth. It just has to be growing, right? We want to see compound growth over time. So my basic criteria is that it should be growing, above sort of, let's just say, CPI, right? So above the rate of change of inflation, which in the long run is roughly 2%. I guess you can increase that to maybe about 2.5%. So that's the idea here. So we want earnings growth over at least a 10-year period, preferably 20-year period, in excess of CPI, which is roughly 2.5%. And then lastly, this is also very important. The share price has regained its momentum by recapturing its 30-week moving average, or has shown some evidence of a technical bottom, right? This is very important because remember, when you're picking these deep value companies, they can stay cheap for a long time. Okay, so this could be a stock that remains in the doldrums for possibly years. So that could be dead money that's just sitting and not doing anything. So I like to, make sure that all 4 of these boxes are checked, right? If you can find, iconic businesses, industry leaders with a long operating history and a very strong moat, okay, one of these needs to be checked. And if you can look at evidence of earnings growth over time, above, say, 2.5% at the very minimum, and if you can find them, that are trading at a Schiller PE that's, 1 to 2 standard deviations below the 20-year mean, or are near recessionary levels in 2008, 2009, and are now above the 30-week moving average. You don't have to use the 30-week. It could be the 200-day moving average. It could be another metric that looks at, momentum. That means that this stock is now ready to rock and get back to multiple expansion. In my view, that is the best way to combine deep value opportunities with momentum and positive returns that are accruing right now. That way you're not, sort of investing in dead money or money. Even if you do have all 3 of these boxes checked, sometimes it can take quite a long time before you start to see returns on your investment. So you want to make sure you add that last point in there. So here are 7 opportunities right now that trade at exceptional Schiller PE multiples. We have Disney, which nobody likes right now. That's exactly the time to get it, in my view, with a very low Schiller PE. 3M, again, this is at a recessionary Schiller PE, and it has reached a technical bottom, in my view. Intel has actually been on a tear right now. I don't know exactly how much of that is because of this, craze that, the semiconductor industry is going through. So I'd probably wait for a little bit of a pullback on this one before entering, but I still like it because it's very cheap in the long run. And remember, there's only 3 semiconductor manufacturers in the world that operate in high volume. So that is a moat. If you can, if there's a moat, Intel's got it. Because there's only 3, right? There's TSMC, there's Samsung, and then there's Intel. So it's basically an oligopoly, and Intel is a part of that elite group. And it is very cheap on Schiller PE right now, I will tell you. Warner Brothers Discovery, this is, again, very cheap. And remember, they own some really interesting assets. They own HBO, they own TNT. If you're a basketball fan, I know I am. I love, the NBA on TNT. So they own that, they own TBS, they own a lot of really valuable media assets. And so I think this is a very attractive, company to own. And it is very cheap on Schiller PE, extremely depressed. Trades at roughly 5, a Schiller PE of 5. So I think, and now it's just recently gotten its mojo back. The stock is actually trending and above its 200-day moving average. I think this is a stock to own. Global Payments, again, very cheap. And this is actually a part of our earnings certain portfolio, along with 3M, by the way, and Disney, and Smucker, JM Smucker. All 4 of these are members of our Zacks earnings certain proxy. That's our collection of elite companies that consistently grow over time. Global Payments is well established as a payment processor in thousands and thousands, possibly 100,000 or so businesses worldwide. They do credit card processing as well as data analytics provided to retail. This is a terrific company, and I think it's trading at a phenomenal valuation, basically at recessionary multiples right now. I think it's a great buy here. JM Smucker, I know it's just peanut butter, but again, it trades at an exceptionally deep value PE. This is an iconic brand that everybody loves. Everyone's got a Smucker's product in their cabinets at home, in their pantries. It's great. And then of course Celanese. So they all check off all 4 of these boxes here. Deep, attractive Schiller PE. It's an industry leader with a moat around their business. They do have compound earnings growth over a long period of time, and the stocks are trending right now. So hopefully you found this helpful. I'd love to hear comments, feedback from you guys. Here is actually a chart of their earnings over time. Look at the opportunities here for Global Payments. This is about as cheap as it gets. And so this is a very high conviction long, in my view, for Global Payments. Same with 3M, very cheap. It only gets this cheap during recessions here. JM Smucker is actually in a good uptrend here, but even though it's not as cheap in terms of its traditional PE, it's still very cheap relative to Schiller PE. So again, if you put it into context of trend earnings growth here, it's still a very attractive opportunity, and I think it's actually poised for a multi-year breakout, because remember, it peaked in 2016. It's been in this doldrums for 7 years now, and it's finally breaking out. So I think it's ready for a pretty big move up. And then of course Intel, again, very cheap. It's going through its own company specific issues as they invest for their next phase of growth. So earnings are extremely depressed. If you're looking at just PEs, this stock looks very expensive, but if you look at Schiller PE, this stock is just about as cheap as it ever gets. So hopefully you found this helpful. I'd love to hear feedback and comments from you. You can reach us if you are a ZRS client. Please send us an email at zrs@zacks.com. And if you are an Advisor Tools client, please send us an email at zat@zacks.com. Thanks, everyone, and hope to see you again on a future webinar here at Zacks Professional Services. Take care, everyone. Bye.